Welcome back. This is Professor Roberts again, and we're going to tackle Chapter 2. But before I do, I want to just remind you, we are talking about financial accounting. Our emphasis will always be with the external users of financial information. We are here to understand what types of information we provide, how we provide it, and the relevant parties that are interested in this information. We talked about the basic set of financial statements, which includes the balance sheet, includes the income statement. It also includes a statement of retained earnings, and it includes the statement of cash flows. We also mentioned some new concepts that are of GAAP, U.S. Generally Accepted Accounting Principles, and how it governs how we present information that's useful for users. What we also discussed was the layout and format of the financial statements. Each one that we talked about has something to do or related in some way to the accounting equation, which is the assets equal to liabilities and equity. We talked also about a little bit on the classifications of assets, liabilities, and equity, and what types of transactions are relevant to those particular categories. In this chapter, however, we're going to get into a little bit more detail about different types of transactions. When we are trying to review a set of financial statements, the question then becomes what information is in those financial statements and how are those numbers derived. And the transaction analysis really does give you the fundamentals of how we're recording transactions and where they go once they are the transactions are recorded and what they really mean. So we're going to go to some very, very finite details, but I don't think the details will be difficult to learn. What is a transaction? How do we define an account and list? And how do we differentiate between different types of accounts? Very, very important for this chapter. We're going to show the impact of those transactions in light of the accounting equation, which we talked about last chapter. We're going to talk about the transactions and analyze the impact it has on various transaction accounts. We're going to journalize, record, and post these transactions in the accounting records. Again, for our purposes, we're doing a lot of things manually. We're using some kind of a MyLab accounting software, but in the reality, all of these transactions that we're going to be recording are really seamless within a QuickBooks or some kind of accounting software. So we're going to be doing a lot of manual stuff, but in reality, all of this is automated and much easier to understand. And then we're going to construct and use a trial balance. We're going to talk about what it is, what its purpose is, and then we're going to talk about how to create it. So what is a transaction? Well, it's going to be an event that has a financial impact. And we can give you an example. For you and I, we go to the grocery store, and we need to buy, how could I say this? We need to buy apples and oranges and some other items for a salad. So we go into a giant food store, we pick out what we want, and we go up to the cash register and we deliver those items they recorded on their transaction, on their cash register. And then we take that transaction's dollar amount and we pay them in cash or some kind of debit card. That transaction is an event that has a financial impact on Giant. It does. In fact, a number of things are happening. We are giving something to me, in this case, groceries in the form of vegetables, fruits, and salad fixings. But also they're receiving something, and what they're receiving from us is a debit card or cash in payment of that. So a sale has occurred. So a transaction is an event that has a financial impact. I just described to you a sales event, a sales transaction that has an impact on the business, and it can be measured. And that's most important. If you can't measure a transaction, GAAP has a problem with you recording something. And we'll talk about that later on as we go on in accounting, but reality is we've got to be able to measure it. And I just did. Here are the items that I purchased, part of their inventory. Guess what? It cost this much for me to buy it. I gave them cash. The transaction occurred. We gave them fruits and vegetables and so forth, and they gave us cash in return. So we want to be able to show both sides of what has happened in this case. So when we talk about that, well, let's go back to our same example. I purchased some apples, fruits, and salad fixings, and I got cash in that. So that means there is an account that was involved. What kind of account? Well, in my case, if I'm purchasing fruits and vegetables and that sort of thing, we're talking about a merchandising type of firm. And Giant is somewhat like a merchandising firm because they don't really make anything. They don't manufacture anything. What they do really is they take something that's already been made, in this case fruits and vegetables or whatever it is, and they sell it to me. So we are going to deal with the account. Oh my goodness, for on Giant's records, they are eliminating through a sale to me their inventory, which is a major source of income for that organization. So the merchandising firm, in this case Giant, is actually making a sale, and they are releasing their merchandise inventory in exchange for cash. So now we know the accounts that are affected. Merchandise inventory in the case of groceries and food items, in exchange for cash. So now we have two different accounts that affect this one transaction. That's what we're doing. We're recording transactions, we're recording financial transactions. We record them because we know what happened and we can rely on the value. Cash was received. Merchandise inventory that would cost them something was given up. So now we know, we can tell what an account is and how to determine the different types of account, which I've given you in this example. So how do we take this one example that I've just mentioned? I purchased from Giant Food Store merchandise inventory for cash. Well, we already know we have to think about it in light of the accounting equation. Remember, the accounting equation is assets. It's the equivalent of the combination of liabilities and equity. So what has happened? Well, the first thing has happened is we have done two types of transactions. And I'm going to take one, for example. One, we have decreased our merchandise inventory. We increased our cash. So increase cash, decrease our merchandise inventory. On the opposite side of it, we recorded our cost of goods sold, an expense, reduction in equity, and we recorded an increase in revenue, the actual sale. So in this case, we have affected two assets and we affected two components of equity. We have balanced the entry. And that's basically what happens when we're recording transactions. We have to think about what actually occurred, what accounts particularly are relevant to this transaction, and how does this transaction fit into the accounting equation, and thus giving us a balanced entry. So an account is a record of changes in a particular asset, liability, or equity account during a period. And we already talked about the examples here. We got cash and got merchandise inventory, which is on the asset side. And on the equity side, we got cost of goods sold, which is an expense. And we've got our revenue. So we have four accounts affecting various different transactions. One's going to hit the balance sheet, one's going to hit the income statement. In the end, we have a balanced entry. So when we talk about different types of accounts, remember, in light of the example I just provided, I purchased merchandise inventory for cash from Giant Food Store. We know on Giant's set of records, they received cash because I gave them a check or I gave them a debit card to pay for my sale, my products that I purchased. But also what happened with their accounts, inventory also went down because they no longer have on their records the fruits and vegetables that I purchased because I have now bought them. So cash went up, merchandise inventory went down. But on the other side of that, however, we have to think about on revenue side. Now again, we did not affect any prepaid expenses, things that we paid for in advance. We did not purchase any investments, and we most certainly did not buy any property, plant, or equipment. So in essence, only two asset accounts in our example is cash and inventory. Let's go to the next side of it. Liability. Did we have a liability? Do we owe them something? And the answer is no. In light of the transaction I just talked about, cash is received, inventory went away, revenue is increased, and cost of goods sold is reflected. None of that affects liability. So in this case, in my transaction, there is no effect on liabilities. Now, liabilities is a promise to pay something. Accounts payable, which is an operational liability. Note payable, which is some kind of debt that has a security of a promissory note, and accrued liability. So we have no liabilities in my transaction, but we do have equity. Equity is affected. Every transaction that we're going to talk about is going to have an effect, and it's going to have a balancing effect on both sides or either one of the sides of our accounting equation. So we talked about the asset side, which you dealt with. Now we have to talk about on the equity side, because that transaction affected not only retained earnings, it affected retained earnings in two different areas. One, a reduction in retained earnings, which is cost of goods sold and expense, and an increase in retained earnings, which is revenue or sales. So now we know the different types of accounts. So when you take a look at the assets, the liabilities, the equity, try to find some examples of each type of account that's relevant to that category. It would make it much easier when you're trying to analyze transactions. Now remember, equity has the components of common stock, retained earnings, dividends, paid in capital as well, revenues, and expenses. And it's very, very important. Okay, so now we know that we have to record those transactions. We talked about the transaction. Now let's show the impact of those transactions within the accounting equation. So Alladin Travel, we have some transactions, and we're going to go over really how these transactions are going to be categorized in terms of the accounting equation. So we have on April the 1st, Star Williams and a few friends invest $50,000 in Alladin Capital, and the business issues common stock. What's happening here is that you'll see that there are two things happening. One, they invest money, and they invest money for something else. $50,000 is the first thing. That's going to be assumed to be cash, right? Because we remember, everything that we're talking about assumes the monetary value of US dollars. So $50,000 in cash was received. What was the exchange, however? The exchange tells you common stock. So when you're looking at transactions, it's kind of important to kind of break them apart a little bit, because it makes it easier to determine which accounts, or which accounts, meaning more than three, affect a particular transaction. We've got one account, which is the $50,000 in cash, and we were able to deduce that the other account is going to be common stock, because it says issues common stock to stockholder. So now we know cash is our asset, which is one side of the equation, but the other side means that there is no liabilities affected here, and the equity is going to be going up. Why? Because common stock is an increase in the equity section of the balance sheet. So now we have a balanced equation. And this is just another way to look at it. Here we go. We got $50,000 in cash and $50,000 in common stock. Boom, that's done. Now, if we purchase land for a new location in the form of cash, so what's happening here is cash is going down. We are going to forfeit our cash for this land. And if you look at this transaction, you'll see that only one side of the asset equation is being affected here. Only the asset side. The question then becomes, is this a balanced equation? Because we're only affecting the assets. We're not affecting liabilities and equity. Can this transaction still be balanced? And the answer is yes. Not all transactions are going to have an effect on both sides of the equation. The most important thing with this is that you have to balance, period. Whether it be a combination of assets and liabilities and equity, or assets and equity, or assets and liabilities, or just equity and liabilities. At the end of the day, the entry has to balance, and this entry does. So we reduced our cash for $40,000, but we also increased our land for $40,000. This is the exact same example that I used previously when I said, okay, Giant Food gave up inventory of whatever dollar amount I paid for it, but they also received cash in the same transaction. And in essence, we have a balanced transaction only affecting the asset side of the asset equation. And don't be worried, because you may see that quite a bit in transactions. Oh my God, I'm not affecting liabilities or equity. It's okay. The entry has to balance. So let's take a look at the next one. The business buys supplies on account, agreeing to pay $3,700 within 30 days. Very important key words. On account means you didn't pay it in cash. That means you pay it later. That means a obligation exists. The amount of the transaction is clear, which means you can record it because you know what the dollar amount is, $3,700. And you know within 30 days. That tells me that, one, I received some type of asset, I have to pay for it later, which is an obligation, and it's current. It's less than 1 year. So in light of that, let's record the entry. We are going to show an increase of an asset called supplies, and we show it here at $3,700, and that's all affecting the asset. Now on the opposite side, we have to show an increase in our obligation, in this case accounts payable. Because it's a very, very short-term obligation and it's part of operating activities, it's going to be called accounts payable. And you're going to see accounts payable for supplies that you purchase, or some kind of utilities that you purchase, or utilities expense, something like that. So again, you're going to have to make certain that your liabilities go up by $3,700, your assets go up by $3,700. The entry is balanced. And we could go on and on. I want to take a couple transactions I think would be kind of neat to look at, and this is on the revenue side. Now, let's take a look at this one here. We're going to skip over some of the transactions because I really want to go over each one of the different groups. This one here is going to be Alladin performs services on account, which means that Alladin lets the customers pay later. So Alladin provided the work. Accrual-based accounting tells us that we have to recognize revenues when it is earned, not when cash is paid out. So the statement that's going to be affected here is going to be the balance sheet and the income statement. It will not affect the statement of cash flows. Let's talk about this in light of the accounting equation first, and then why the statement of cash flows is not going to be affected here. One, we have an expectation of an asset, an expectation of cash, in fact. So we got an asset here of $3,000. We're going to perform services. Now, we did the work, we don't have the money. So I'm going to increase my asset, my expectation, my receivable from that client of the $3,000. But I also want to show an increase in my equity, because equity is going up because revenues are going up. So here we have our services revenue of $3,000. We have a balanced equation showing not only that we earn the money, but we have a receivable on its books. Now let's do another transaction that has effect on expenses, and I think this one will be very, very nice to think about. Alladin during the month pays $2,700 for the following expenses: $1,100 for rent, salaries of $1,200, and utilities for $400. In total, we know that based on this, gives you a clue that cash was paid. This is a very, very general rule, and I think you can rely on it. If $2,700 was paid, we know our cash has gone down. So right here in our accounting equation, we're going to show a reduction in cash of $2,700. And based on the information, no other asset is affected here. So we can skip over AR, supplies, and land. Now, on the opposite side of the equal sign, we got to think about it. Is there an obligation? Do we have to pay anybody? No, we don't owe them anything. We basically have paid them with the cash. So accounts payable is excluded. Number two, common stock is not affected here because these are not any relationship to dividends or stock or etc. No equity impact whatsoever in terms of common stock. Retained earnings, however, is affected. Why? Because retained earnings goes up or down depending on if it's a revenue or if it's an expense. If it's a revenue, retained earnings goes up. If it's an expense, retained earnings goes down. In this case, retained earnings goes down by the $1,100 in the rent expense, $1,200 in the salaries expense, and $400 in the utilities expense. So we now have been able to complete this transaction, and this transaction actually balances. So let's think about this one. What about the transaction that we paid on account? We purchased something, and now sometime later we decide we're going to pay it. What is the appropriate way to handle this transaction? Well, on account lets me know that accounts payable has something to do with it because it tells me accounts payable. But it also says pays. So you have to assume if you paid $1,900, you've paid it in a form of a check or cash. So our cash is going down by $1,900. No other asset is being affected in this transaction, only cash. So we can ignore AR, supplies, and land. The next side is then liabilities and stockholders' equity. Well, there's no retained earnings effect, no revenues or expenses. There's no common stock, but there is an accounts payable. We need to reduce the accounts payable by $1,900. So in this transaction, we're reducing our cash and we're reducing our liabilities. We have now a balanced entry. So let's look at this one here. Now, again, whether or not we record an entry, we have to understand what has happened. And does this have a business effect? Star Williams, the major shareholder, paid $30,000 out of her personal bank account to remodel her home. Obviously, this has no business impact whatsoever, and there will be no entry on the books. The most important thing with these transactions is to understand truly what's going on with the transaction, what actually happened. Analyzing it. So for example, if we perform services for a client and the client now pays you back, we need to record that. And you will see in this case, it's not going to affect but only the asset side. Because look, we're going to reduce the expectation that we're going to receive money from our client of $1,000, and we're going to increase the cash. So in this case, the asset equation has balance, and the only impact it has is on the asset side. It decreases the asset of accounts receivable, but it also increases the asset of cash. And you may see quite a number of transactions that may very well be similar to this. Don't think that you got the entry incorrect, because in this case, it's only affecting the assets. And the entry does, in fact, balance. Now, let's think about this transaction here. We are going to show a payment from Aladdin for $22,000. $22,000 was sold for land, and Aladdin pays for the land. So they are going to deal with a decrease. Let's see, Aladdin sells some land for $22,000, which is the same amount Aladdin paid for the land. So there's no difference in value. So we are going to receive $22,000 in cash. And we're also going to show a reduction in the amount of land that we have on our books. Because part of the land that we had, part of it we sold away. So we're going to reduce the asset again to balance this equation. Again, we are increasing our cash, which is an increase in cash or an asset, and we're going to decrease our asset, in this case a decrease in land. Our entry does in fact balance. So let's look at another transaction. If we declare a dividend and you pay it, and you pay $2,100, we are affecting cash in this case. Cash is going down. When you pay cash, it goes down. When you receive cash, it goes up. So in this case, we're going to reduce our cash by $2,100, and we're going to show a change in retained earnings. Why? Because retained earnings is changed by revenues, expenses, dividends, and common stock. Those are the type of transactions. And again, it's a matter of understanding the type of transactions that affect various categories: assets, liabilities, equity. And so we just have to make certain when we're looking at the transactions that we are actually able to identify how to categorize the transaction. Is it an asset? Is it asset going up or down? Is it a liability? We owe money to people, or are we paying back money that we owed? A liability. Are we receiving monies from equity in terms of common stock, or did we receive revenues or earn revenues, or did we pay out expenditures? And again, having that information within a transaction detail description does help you categorize the transaction better and accurately. And again, here we are looking at the effects of these types of transactions on the financial statements. I truly believe the most important thing for this chapter is to understand how to appropriately record transactions. And we will, over time, understand how to apply those changes to the financial statements. So how do you analyze the impact of transactions on accounts? Again, we use a double entry system, meaning the debits have to equal the credits, period. No exceptions. You can rely on this one truth, fundamental truth, that's going to apply in every case at all times. There will never be an accurate one-sided entry. All entries have to have two sides, and they have to balance. Now, you don't have to have the same number of debits as credits, so long as in total they agree, and that's the most important thing. So here we go. Now we're going to talk about T accounts. Now this is something that I think many students have always seemed to have problems with. So I'm hoping this presentation does provide some help, but we'll talk about this more over time. So initially it may not seem intuitive, so just be patient. Here's a T account, and T account really it's like a journal. And if you're using a software program, it's basically a ledger, and it does give you a record of the type of transactions and all the transactions, debit and credit, so forth, and then all of it obviously gives you an ending balance. But when we put things in a T account, we basically are trying to identify and categorize a list of transactions and then what the impact it has on a specific account. So when we record increases and decreases in assets, liabilities, equity, or revenues or expenses, we need to understand how they are shown within a T account. So if we're going to record a transaction on the left hand side, it's going to be a debit regardless of what account it is, whether it be asset, liability, equity, or revenue. If we record a transaction on the right hand side, it's going to be a credit. So the main thing is debits on the left hand side, credits on the right hand side. Okay, now with that in mind, we want to be ensured that if there are accounts that are assets will always have a normal debit balance. So you will always see them on normally on the debit side, on the left side of a T account. Liabilities and equity, with the exception of expenses, are going to have a normal credit balance, and you're going to see them typically on the credit side. So when you want to reduce either one of these, you have to first understand what's their normal balance. An asset is going to a normal balance be a debit. So if I want to make my asset go down, I have to do the opposite of that. The opposite is going to be a credit. Conversely, if I want to reduce a revenue account, like for sales revenue, and I record an exchange in the case of someone returns a product and I have to reduce my revenue that I've recorded, what do? We have to record the opposite. And a revenue account will have a credit balance, so the record the opposite would mean I would have to record a debit to reduce that revenue account. The same is true if I'm recording an obligation like a liability, accounts payable, for example, and I record accounts payable as a $500. But when I pay that bill, for example, and I have to reduce the obligation to zero because I paid it off, I have to reduce it with the debit, because credit side for my liabilities are going to be my normal balance. And to reduce my normal balance, I have to do the opposite, which would be a debit. So to reduce my liability, I have to debit it. To increase my liability, I have to credit it. And the opposite is true for assets. In this case, we are using cash for an example. All assets have debit balances normally. All assets. That includes personal property, equipment, inventory, cash, prepaids, etc., accounts receivable. They all have normal debit balances. As such, we have to reduce those numbers with credits. Revenues will always have credit balances, sales revenues, etc. And to reduce that revenue, we have to debit. Accounts payable is another item, or note payable has normal credit balances. When we pay off that balance, we have to debit it to reduce the balance. And this is a very good one. I think if it's possible, this is a sheet that you should print. You should print it until you know it like the back of your hand. And what it tells you is this: if you have an asset, you want to increase your asset, you have to debit it. If you want to decrease your asset, you want to credit it. And the same is true for liabilities and equity. This is an extremely important slide, which I highly recommend you print as you're working on your homework assignments, because initially it may not necessarily become second nature, but over time, and the more transactions you record, it will become much more easier to understand and easier to apply. So now, when we show the transactions in this case in a T account form versus in the form of assets equal to liabilities and equity, the asset equation, now we're looking at it from a T account perspective. We're visualizing it in a different way, but it's still the conclusion is the same. We are going to increase our cash because someone gave us $50,000 in exchange for the common stock. So our cash is going up. However, common stock is also going up, but it's going up because it's going up in a credit. And to increase an equity item, you have to credit. So we got a debit to our cash and a credit to our common stock equity. Our entry is balanced. Our debits, 50,000, equals our credits of 50,000. And here we are looking at these transactions from a T account after the first two transactions. Now, I don't want to go too far in that because I think practice is really going to be key. So when we're talking about the income statement accounts, we're talking about revenues and expenses. Now remember, revenues and expenses are equity items, period. How they affect equity or retained earnings in this case does vary. Revenues are going to increase the stockholders' equity. So that means we're going to make it go up. And if it's going to go up in the equity, it's going to be credits. Expenses decreases stockholders' equity. And decreasing equity means you have to make it go down with a debit. So revenues are credits and have normal credit balances, and they are increases in equity. Expenses are debits, they decrease equity, and they make the equity go down. So having that knowledge and remembering that is important, but more than that is applying it with problems over and over again. And that's my suggestion. Working these different transactions, understanding how to classify the accounts, understanding the relationship between debits and credits and its impact on the various accounts, and knowing how to ensure that when you record a transaction that it's absolutely balanced. Your debits equal your credits. And these are going to be a fundamental truth that is true in every situation. And here we are showing the rules of debits and credits. And again, I don't want to belabor it. I do want, however, to show you just how important this chapter is and how I believe is important for you to reread and practice. So, recording transactions, we're going to identify the transaction by its type. We're going to determine what count is increase or decrease, and we're going to record it in a journal. Simple as that. In the journal, here is an example of a company receiving cash and issuing stock and how it's recorded in a journal. And then we transfer those journals. In this case, cash is a journal, accounts payable is a journal, common stock is a journal, and we're going to transfer them into a ledger, and then we're going to create a trial balance. So the transaction occurs, we analyze the transaction, and analyzing it means what has happened. Has there been a financial impact on record? Can we actually record this transaction? Can we tell what has happened? Can we measure what has happened? We record the transaction in your journal, and then we post it to a ledger. A ledger in this case is going to be the specific accounts that are affected. Cash could be one, accounts receivable could be another, accounts payable could be another, for example. So in that end, I want to first of all skip to the different types of transactions that I think might be helpful for you to grasp. When we record a service and we receive cash, two things has happened. One, we have recognized income and we have recognized the receipt of money, $7,000. So if we got money, that means we received money. That means cash is going up. If cash is going up, we already know that cash has to be debited. And that's one side of the entry already done. Now, services equals revenues, period. If revenues is going up, we know because revenues is a stockholders equity item, and when it goes up, we have to credit. So now that we have our debit, we automatically know what our credit is, and our entry has essentially balanced. And we have not violated the rules of debits and credits, nor have we violated the rules of increasing cash with a debit and increasing a stockholder equity account with a credit. And that's essentially what I wanted to show in these transactions. I also want to make certain that, remember, when we're going through these transactions and we're trying to understand what's exactly happening and going on, we need to be certain that we are able to identify what has occurred. That's the first step. The second step is to, can you determine, based on the information provided, what ledger accounts are impacted? Number three, can you determine, based on the ledger accounts that are impacted, what effect do these transactions have debit credit wise? If I'm increasing an account, if that's an asset account, I know now because I know I have to debit that. So if we know what accounts, we know how these accounts are applied in debit and credits and how to increase them with debits or credits. Now we can create a journal entry. And when we create the journal entry, we have to ask ourselves one thing: does the debit equal the credit? That's a fundamental step, and it's the first critical step in ensuring that your entry balances. We have to have balanced entries. So With that being said, I don't want to go into it too much because I've already gone over my 30 minutes, but I want you to know that this particular chapter is absolutely critical, and I think you should spend a tremendous amount of time understanding the relationship between debits and credits, increases and decreases, and the various ledger accounts. Now, how do we use a trial balance? A trial balance really does allow you to take all of your ledger account balances. Remember, we saw a ledger, and here is an example of a ledger. Here's our ledger accounts, and it has here cash and all the transactions. We're going to take those transactions, the net amount of those transactions, and we're going to transfer them to a trial balance. And what a trial balance shows is a list of all the accounts and their balances in debit credit format. That means our trial balance has to equal debits, have to equal credits. And here is an example. Don't worry about learning how to prepare just yet. My goal in this presentation is simply to allow you to see what it looks like and understand the purpose of it, because we're going to use this information to create financial statements. So here are all of our accounts in debit credit format, and each one listed in total. We want only the ending balances, the net ending balances of each one of our accounts. We don't want all the details. We just want the ending balance for each one of our accounts. And we want the net ending balance. That means it might be a net debit balance or a net credit balance, but at the end of the day, we don't want to see cash with a debit and a credit. We want to see only the net. And then, as you can see at the bottom, each total is equivalent. The debits equals the credits. So when you're preparing your trial balance and you see your debits don't equal your credits, you know there's a problem. When you see your trial balance and you see a debit and a credit in one account, you know there's an error there. These are the common mistakes that I've seen over the years, and one of the things I want to alert you of immediately. That's a common mistake, and it's an easy one to fix. But in the end, this particular trial balance allows you to know exactly all of the transactions, the ending balances of each one of the accounts for that period. Then it allows you to create your unadjusted trial balance, because right now this is an unadjusted trial balance, and we'll talk about adjustments in another class. But for now, this trial balance is a very important final piece of all of the transactions that you've entered during a period. So I'm going to stop at this point and say to you, when we go through these transactions together in some type of entries and corrections, etc., you can understand exactly the logical flow of all of this. It all does make sense. It all comes together and it has relevance and meaning. Now, as I mentioned before, the common mistakes that I have noted over the years: you missed an account. You're out of the balance for some reason. Did you put a debit when it should have been a credit? You can fix that just by dividing out. Did you transpose a number? Did you create a balance or a transaction that is a debit and it should have been a credit? Types of errors. Does your trial balance equal debits equaling credits? Common mistakes that you can easily pick up on and fix without exception. And here is again the normal balances of accounts, which I've mentioned previously. This is something I think you should print out as well. It's quite important to remember. You will not need this forever, but for the first 4 chapters, I truly believe you should rely on it to help you through when you're actually working on your transactions. So as I conclude, I want to say thank you very much for your time, and I believe this is a very, very critical chapter, and it would be very helpful to you. And as always, I appreciate your time, and I will talk to you again in the next video.